Hi, everyone. I'm Nicole. I work for UMCU, and I'm the financial education specialist. So I have worked there for just over a year now, but I have been doing financial or credit counseling for close to 9 years. So it's been a little bit of time, but I do a lot of presentations throughout Ann Arbor for the community and like at the different college campuses. So we also do them in like Dearborn, Flint, Eastern, Washtenaw Community College. So kind of get to travel around, which is fun. But so with this workshop, we're just going to go over some different basics. So we'll talk about budgeting, we'll discuss savings, and then we're going to talk about credit as well. So as we go throughout this, feel free to ask any questions or if you have any comments, and then I'll try to leave some time at the end too if people have any questions, just so we can cover those. So I just want to start with this question, but over the past year and a half, what have been some financial challenges for consumers? So it might be, something that's impacted you directly or just things that you've been hearing about from other people or on the news. Inflation, yep. So that's been all over, especially since the pandemic. I feel like we hear about that all the time. Anything else you can hear or you've been hearing about? And feel free to just shout it out.
Unexpected expenses such as medical expenses.
Yeah, unexpected expenses, medical. So that's definitely a big one for a lot of people. So medical, any type of debt that comes up and it's a big expense can be difficult to cover those. This is kind of my list. So we talked about inflation, cost of housing, so rent and mortgages have gone up quite a bit. Rising interest rates, so that also they've gone up a lot since the pandemic. Like mortgages used to be in the 2%, now they're I think like around 7%. How much should I invest? I feel like that's a big question for a lot of people, paying off debt and then caring for a parent or child. So a lot of these things make it difficult to manage our money, but it is something that, some of these things that we're going to talk about today can definitely help try to kind of manage these. So if I were just to ask, what's the difference between these two, financial literacy and financial capability, how would you describe them, or what would you say the difference between them are? And sorry, you said a practice? Okay, for the capability? Yeah, yep. And then the literacy, any ideas what that would kind of entail?
Probably knowing, understanding what to do versus capability, whether they have the means to.
Yes, you got it exactly. So yeah, the financial literacy is the knowledge or what to do, whereas the capability is choices and actions or having the means to be able to do something. So they are different. The goal, of course, is to be where that little star is at. So I kind of say I can tell people all that I want that credit card interest rates are high and, try not to accumulate credit card debt. But if they choose to put, a $3,000 vacation on it, that's sort of on them. Whereas on the other hand, for the capability part, let's say somebody has a lot of money that they can save and they're putting money away for savings, but they don't know how to invest it, there's gonna be some lack there. So the goal is to, again, have a combination of the two, and that's really gonna be the recipe for success. So I just want to do kind of a quick basic financial literacy question quiz. So this first one says, it is suggested that households allocate this much, so what percentage of net income towards their overall monthly housing expenses? So that would be like rent or mortgage, basic utilities, and then like homeowners or renters insurance. What do we think? Yes, you're pretty much spot on. So about 35, no more than 40%. But yeah, I mean, if you can be at 30% or lower, that's always great. If people are spending more than that, then a lot of times what I see is the savings portion gets cut out. What is the range of credit scores one could have from lowest to highest? Really, you're close. So you got the 850, and I always say I don't know why it doesn't go from 0 to 500. Yeah, yeah, but it starts at 300, goes up to 850, and we're going to talk a little bit more about this a little later. What is the names of the two types of individual retirement accounts or IRAs that are available to consumers? A lot of people say that, yeah, 401k. That's not one of them, but that's a good guess. Yes, Roth is one of them. Does anyone know? Ooh, close. It does start with a T. So it is traditional and Roth. So the difference between the two is that traditional, you're putting in your money pre-tax, so that when you take distributions or when you withdraw that money, you're going to have to pay taxes on it. Whereas with the Roth IRA, you're putting in that money post-tax, so money that you've already paid taxes on. So when you pull from it, you don't have to pay taxes. So benefits to both of them. And then of the following, which typically carries the highest interest rate or APR? Is it private student loan, mortgage, credit card, or auto loan? Credit card, do y'all agree? Yeah, unfortunately, credit cards. So typically, aside from like any other debt, aside from maybe like a payday loan, credit cards in general are going to have, the highest interest rate. And then how often can you get a free credit report from each of the three major credit bureaus from that website? So annualcreditreport.com. Is it once a day, once a week, once a month, or once a year? Okay, that's that's a really good guess. And this one, they actually changed over the pandemic, and they switched it to weekly reports for free, which is really nice. But they should change probably the website name to weekly credit report. But yeah, actually once a week, which is nice because just to make sure there's not identity theft and to make sure everything's accurate. And then how many years will a 30-day late payment remain on your credit reports? Is it 1 year, 3 years, 5 years, or 7 years? What do you all think? Yeah. Yeah. So yeah, unfortunately, it is 7 years, which is a long time. So the older that it becomes, though, the less it impacts you, which is a good thing. So yeah, I skipped one of my slides. So with personal finances, I kind of say there's good and bad. So the good thing is that we can learn about this stuff. So you can learn how to do a budget, you can learn how to invest your money, how to have a high credit score. But on the other hand, emotions and values definitely play sometimes a big role in how we make financial decisions. So have you all heard of FOMO, FOMO, fear of missing out? What about YOLO? So you only live once. So it's just that, sometimes we're going to see our friends or family members or, people online doing things that we want to do or buying things that we want to buy. And so that can influence us. And sometimes, we might spend more than we really want to or that we actually have. So that can be tough. And then another thing that I've also seen quite a bit with the financial counseling that I've done is that not all, but some financial decisions can sometimes impact you for quite a while. So, if we decide tonight to go out to eat rather than cook at home, that's not something that's going to have a huge financial impact or not something that's going to stick with us. But if someone, let's say, takes out a mortgage or an auto loan or a student loan and it's really not affordable for them or something happens where they're not able to make those payments, that's something that's not going to go away overnight. So it's usually going to have some sort of financial impact on their credit or, their financial situation. So I just tell people, try to be thoughtful, try to get as much information as you can, especially with those bigger financial decisions, because sometimes, it's difficult to think on the spot. So really want to try to think about them, carefully. So this is what I like to call our blueprint for financial success or financial wellness. So it's the Save, Spend, Borrow plan. And actually one of the sheets that you have has these on there, but most of these are pretty easy to understand, right? Like spend less than income and pay your bills on time. I think we've all been told, have savings. And it's okay to borrow money. It's not bad to take out loans or to use credit. It's just that hopefully you want to make sure that it's affordable and that you're hopefully not paying a super high interest rate. And then planning ahead. So planning ahead for expenses and having appropriate insurance. But the hard part is that life happens, right? So people have hardship, or sometimes they may not have enough income, or sometimes they just don't have the education or the tools to be able to know how to do these things. So, but if you kind of follow this, I would say this is a good, again, a good blueprint or just like a good guideline to be financially healthy. So the very first thing that I always recommend to people is to have some sort of spending plan or budget for your money. Does anyone in here right now have something that they use to like track or budget expenses? Okay, see a couple hands, which is good. So just having that transparency, so being able to see what's coming in, what's going out, is gonna be really helpful. Because I would say, like, probably 95% of the time when I talk to people and I'm talking to them one-on-one and I ask them if they have anything they use to track expenses, most of the times it's no. So it makes it really difficult to be able to save or pay off debt, and just having a clear picture of, whatever their financial goal is. So it's pretty simple with the budget, right? There's income and expenses, and the whole goal is we want them to balance. So, and it seems simple, but I talk to people all the time, kind of regardless of their income. So I'll talk to people that are on fixed income or have, very modest wages, all the way up to people that, have super high incomes, but because, again, they don't have any plan for their money, they're kind of spending beyond what they make, and they're not able to balance things, and they're falling behind, or they're creating debt for themselves. So what I recommend for the budget, you should probably do it monthly, because that's how most of our bills get paid. And it needs to be tangible. So when I say tangible, just meaning something that you can physically see. I talk to a decent amount of people too, where they tell me they keep everything up in their head, which for some people that works, but again, it's hard to kind of see totals and like the different categories that you're spending in if it's just in your head. And then it is going to require some planning ahead and also looking back or tracking. So I think for the budget, it's always good to, for the next month, try to either predict, or if you know what some of your expenses are, write those down. And then as you're going throughout the month, tracking what you actually have spent so you can compare the two. So when you're doing the budget, you want to look at both spending and savings. So these are just some different tools or methods that you could use. So that Excel spreadsheet, that's actually something that we use with members or people when they come to us for financial counseling. And some people just like pen and paper, so it doesn't have to be anything fancy. And then these are just a couple popular budgeting apps, so YNAB, or You Need a Budget, and Pocket Guard. And there's several other budgeting apps or tools that you can use, but just seeing what works for you. And it doesn't have to be anything complicated, so I tell people, you can make it as detailed or as kind of broad as you want, as long as, again, you have sort of an accurate picture of where you're spending and what your income is. Yeah, so that Excel spreadsheet, right, so if anybody wants that, I can email it out to you, or you can shoot us an email at education@umcu.org. Yep, and we're happy to send that out to you. So it's kind of nice. You can break it up by month and have everything in the same place, and it does some of the math, which makes it a little bit easier. Yep, so just to kind of break this down a little bit more, because I do talk to some people, they're like, I know how to do a budget, but I talk to other people, college students, even adults that have no idea where to start. So again, for this column, for this sheet, it has the budget, which is where you kind of plan out the month and what you want to spend. And then the actual is where you sort of track throughout the month and total up what you actually have spent. So I think it's always helpful, start with your income. You do want to use net income because that's actually what you have to spend. And then, again, for, let's say, what are we in? We're in May. You kind of put down what you want to spend or what you're going to spend in this budget category. And then every, maybe few days or at least once a week, actually go through and, if you have your receipts or your bank statements, put down what you actually spent and then kind of update that every week. And then at the end of the month, at that budget summary at the top, it's going to give you a comparison. So this is just sort of a guideline. We saw this a little bit earlier, right? But guideline of what typically you'd want to be spending on these different categories. And I mean, everyone's going to be a little bit different, but I think this is a good amount. So 35% housing. So usually housing, transportation are going to be the most expensive costs for most of us. Other living expenses, so food, other utilities, and then debt repayment maybe about 15%, and then trying to put about 10% into savings. And then has anyone heard of this, the 50-30-20 rule? Okay, yeah, so this is just sort of like a simplified version of that last one. So about 50% of income would go towards your needs. 30% would be on wants, so sort of those fun things. And you always want to include that. I mean, if you're kind of spending all your money on needs and then nothing, and then maybe the rest of it on savings and nothing for anything fun, that's going to make it tough to kind of sustain that. And then the rest of the 20 would go into savings or debt repayment. So just some of the benefits with having a budget or a spending plan is avoiding excessive debt, especially that high interest debt like credit cards, which we're going to talk more about. And then just being able to keep up with your bills. So what I've seen is a lot of times when people start to get behind, it makes it really difficult to get caught back up because of all the late fees and the interest they start tacking on to catch up. And then the other thing is maintaining consistent savings, so something that you're doing on a regular basis. Does anyone like coffee? So I love coffee. And, for this, I'm not saying, don't treat yourself or don't ever get a Starbucks, but it's just that sometimes when it comes to our budget, sometimes we think that those little expenses don't matter, they don't count. Like it's just a $6 coffee or it's just a $3 snack. But if that's something that kind of is, let's say, a treat, maybe a couple times a week, and then it starts becoming a habit, that's extra money that could be going towards savings or debt repayment. Or I say, like, maybe you're trying to save up for something a little bit bigger, like maybe a bigger ticket item, or you're trying to take a trip somewhere. So that's something that's going to last you a little bit longer than a coffee that's going to be gone in like 10 minutes. So just be careful of those little expenses. And same thing with these, right? I'm sure all of us have at least, a couple of these. I know I do. But just make sure that you're getting good use or good value out of them, because I'll talk to some people where they'll have, 4 or 5, 6 of these, and they haven't even, watched them or used them in a year or a few months. So the nice thing is we're not kind of locked into those contracts like the old days. So I always encourage people, maybe every few months or at least, once a year, maybe go through the subscriptions that you have. And if you're not using them, consider getting rid of them, and you can always get them back later if you really miss them. So just some tips with the budget then. So has anyone heard of the 24-hour rule? Okay, so this is something that I actually try to start implementing. You can do this in person. I try to mostly do it online because, with Amazon, things like that, it can be a little impulsive. But what I try to do is if it's something that I don't need and I wasn't planning on buying it, I will put it in my shopping cart, wait at least a full 24 hours, and then if I'm still really thinking about it or really want it, then I'll go ahead and purchase it. But a lot of times after that time has passed, like I realize it's not really something that I wanted. In the grocery store, I think a lot of us know that typically is going to be cheaper than dining out or fast food. And then another thing I like to do sometimes for dining out is maybe consider using cash for smaller purchases. So I know this is getting harder nowadays because a lot of places are only accepting cards or going cashless. But what I'll do is each month I'll put like a set amount of money aside, physical cash, that I kind of limit to my dining out or fast food. So I use that when I eat out, and then I can physically see, when it's gone, and I can't eat out anymore. Auto pay your bills. So that makes it simple, right? You don't have to do any work, make sure everything's paid on time. And then something that I also use, coupons, discounts, rebate apps. So I use my Kroger card, try to get my gas at Costco, and then I have a lot of different like rebate apps like Rakuten, Shopkick. Does anyone use anything like that, like the rebate apps or websites? No? Okay. So.
If I'm shopping online,
Uh-huh.
before I hit buy, I almost always will Google
Yeah.
website discount.
Right.
Usually get like 5, 10, 15% off.
Yeah, yep, that's a good way to do it. So yeah, look for coupons, and the rebate apps are nice. Sometimes you can get like gift cards or cash back. So just some ways to get a little bit extra for your dollar. So I had mentioned savings. So this again is something important to try to factor into your budget. And what would you say for this for you? Is savings like a habit or is it an event? An event, yeah. I think for most people, yeah. It's tough, right? So it's not easy. And again, majority of people that I talk to when I do financial counseling are not able to put money aside for savings, or they're really trying, but they have to, consistently pull from it. So the goal, of course, is to make it a habit, right? Something that we're doing, every pay period, every month. Whereas an event is something that happens kind of sporadically or once in a while. Sometimes I'll talk to people where they'll get like a bonus or they get their tax refund and they put that in savings. That's not a bad thing, but sometimes if that's the only time people can save, it can be a little bit tricky because if they're relying on that for bills or if something happens and they don't have the money or they don't get as much as they were expecting, it's difficult to cover everything. So I like to consider savings as a bill that we pay to ourselves. So if you're able to, trying to prioritize that. What I've noticed is that sometimes people think of savings as kind of like an afterthought where they'll pay all their necessities, they'll do all the fun things, and then they see if they have money left over for savings at the end of the month. And most of the times they don't. So I try to encourage people, again, if you can, if you have some extra money, try to pay for the needs, see if you can put money in savings, and then sort of, see what you have left for the fun stuff. So there's 3 buckets of savings. I kind of like to break it up this way. So the first one is emergency fund. I think we all kind of know what that is. So, house repair, car repair, medical bill. And generally what is recommended is to have about 3 to 6 months of essential living expenses. Just if anything happens, you can cover yourself. And then the next one would be the living life fund. Does anyone have an example of what would kind of fall under that category? So living life. So I would say kind of more like the fun things. So maybe you're trying to go on a vacation, or maybe, during the holidays, a lot of times we spend more on gifts or like different events. Or even if maybe you're trying to buy a new car or buying a house, a lot of times those may not necessarily be emergencies, but something that you definitely want to try to save for if you can. And then the last one, which is more sort of the long-term planning, is going to be retirement and investing. So generally what most financial advisors would recommend to put away for retirement is about 15% of your gross pay, so your money before tax. And if you get any employer match, that would count towards the 15%. So tip that I always give to people for savings is to try to automate it. So when you take the work out of it, that can really help with being able to save that money and hopefully keep it put. So a few different options here. So you can split the direct deposit sometimes through your employer. So before you even see your money, sometimes employers can put a certain percentage or amount into one account, the rest of it into a separate account. If they can't do that or you don't want to, sometimes you could do auto monthly transfers with your bank. So have, every pay period or every month, just have a set amount go into your savings account. And then one that I actually started doing, and not really on purpose, but I first had my credit union account, and then in college I got a Chase account. And so I keep my savings in my credit union account. So sometimes when there's more separation, if it's an account that you don't check as often, or it's not as easy to transfer that money and just spend it, it kind of makes me stop and think, like, is this something that I really want to be pulling from my savings? So, maybe consider a savings account at a different bank or credit union. And then the last one, again, this is a little bit more of the long-term planning, but just participating fully in your 401k, 403b plan. So those are workplace retirement, just depending on if it's a for-profit or nonprofit company, but trying to do maybe 10% or at least trying to get the employer match if they offer that. So if I were just to ask, what's the difference between savings and investing? What would you say? So I know a lot of times we're told to do, both of them probably, but what would we say? Like, what's the purpose of savings? Mm-hmm.
Savings, I believe, is like knowing your money is safe, where there isn't virtually any risk of investing.
Yeah, absolutely. That's a perfect definition. So he basically said that savings, you want to make sure that that money is safe and there's no risk involved, whereas investing is kind of like a roller coaster. So it goes up, it goes down. That's like a perfect comparison. So for savings, like you said, you want that safety, security. You don't want to lose a dollar. So if you're trying to build up an emergency fund, that's money that you're going to need right away, and you don't want to lose any of it if, let's say, you need to replace a tire, or even if you're trying to save up for a house or a car in a year or two or a couple years. Whereas investing, the whole point of that really is to grow our money and to build wealth. But again, as you had mentioned, there is going to be risk involved. So that's kind of the tricky part with investing. But in the long run, it has shown to be a great way to help build wealth and grow our money. But it could go up, could go down, and if, let's say, you're trying to save for a house, you had that money in the stock market, and you could lose potentially a bunch of it overnight. So you don't want that to happen, because it's really going to set you back. So these are some really safe savings options where you could potentially get a little bit more interest compared to like a traditional savings. Does anyone know right now what a traditional or standard savings account, how much interest they're paying at the moment? No. So right now, it's like most of them are less than 1%. So, if you have a savings account, you probably know if there's any money in there. You might be getting cents or a few dollars every month on the money that's sitting in there. Whereas a lot of these other options are sometimes offering between 4 to 5%, and you're generally not going to lose any money with, the CD, the money market account, high yield savings, the treasury bonds. They're all really safe options. The only time you might lose money is if you had more than $250,000 sitting in that account and the bank failed, which is not going to be very common.
Quick question about CDs. What is your 6-month rate right now?
I'll be honest, because we just had a promotion going on for 12 months and it was 5.144, but I think right now our rates are somewhere between, I want to say like 2 to maybe 4%. So they're going to be a little bit different, right, depending on the term and the amount and the bank that you go to, but it can be helpful. Yep.
What he said was 6 to 12 months, does that mean that put it in that you can't access it for that period?
Yeah, exactly. Yep. So how the CD works is, so let's say for UMCU, you give us $1,000 to hold on to. You can't touch it for whatever term you pick. So 6 months, 12 months, it could be a few years. And then, if you pull from it early, there's going to usually be some sort of penalty. But then after that term is up, we will guarantee a rate of whatever the interest rate was when you got it. So yeah, it can be a really safe option. The money market account, high yield savings. So I would say CD and high yield are usually going to be the most popular options for people. And the high yield is basically kind of like a standard savings account, except it's typically associated with online banks. But a lot of times with those, there's no minimum deposit. Most of them don't have any fees. The only thing is sometimes they might limit how many times you can pull from it each month, but a lot of them don't have that anymore as far as I know. So these are just some popular companies that are offering that. So again, these are great options to look into if you're maybe trying to build up an emergency fund, or you're trying to save up for a home or a vehicle and you just want to get a little bit more interest.
One more question related to that.
Yeah.
Based on your experience, are the rates higher at credit unions versus, say, your JP Morgan Chase or Bank of America? I know a lot of credit unions require you to
For all these options, or
primarily CDs.
CDs, I would say they're pretty comparable. Ours, without the promotion, ours I think might be a little bit lower than some of like the major banks. But if they have promotions, or some credit unions, depending on the time of the year, it might be pretty much the same. Yeah. But it's always a good idea to kind of look around online, see what the different rates are. Because might be worth going to a different bank if they have a higher rate to get that. Yeah, I love Bankrate. NerdWallet has a lot of great comparison articles as well. Yep, so NerdWallet. Yeah, the only thing I will say with these for emergency fund, again, keep in mind that like the CD, your money's kind of locked away, and also the high yield, like because they're typically online banks, it might take a little bit for that money to transfer. So you might need a few days before you can access the money. So I think it's always a good idea to still keep some of the money in traditional savings. And then this just talks a little bit about the impact of investing and starting as early as you can. So for all these people, they invest $200 per month of their own money and assume a 7% rate of return. And so kind of starting with the person in red here that starts at age 45, in 20 years, by the time they retire at age 65, their money has about doubled. Whereas the person who starts at age 35, so they have contributed $72,000 of their own money. By the time they retire at 65, their money has about tripled. And then the person who starts though at 25, they have contributed $96,000 of their own dollars. And then by the time they retire, their money has grown by about 5 times. So again, what I always say with investing in retirement, it's not necessarily how much you can put in. So even if you can only do a small amount, really time is the best thing for investing, so trying to start as early as you can. So we're going to kind of move into the credit section. So this is something that I do always like to talk about, with most of my presentations, because credit is something that impacts a lot of us and a lot of aspects of our lives. And especially with credit cards, that's like the #1 type of account that I see people sometimes get into trouble with because of how easy it is to spend on them and how high the interest is. So this is just a quote from WalletHub.com, and this was as of April 29th, so a few days ago. So what are your guesses on the average credit card interest rate for new offers and then for existing accounts? What do y'all think? Okay, guess for 10, 25. Good guesses. What do you all think? Do you agree, disagree? Think it's higher or lower? Okay, 17 and 12, so a little bit different. So, they are pretty similar. So new offers right now, almost 23%, and for existing accounts, almost 22%. So it's extremely high. And this is not just for people that have poor credit. Like, this is even for people that have credit scores in the 800s. So credit cards can be a really expensive way to borrow, and that's why I tell people just be careful with them. We're going to talk a little bit more about the score and how you would want to properly use a credit card to make sure it's helping you and not hurting you. So, and then retail and student credit cards. So we have Macy's, and then the Saver One, Capital One, they have a student and a regular credit card, but any guesses on what the current interest rates for these are? 16, 17%. So you're going to be a little bit sad, but right now Macy's is almost 32%, and that Capital One anywhere between 20 to 30, depending on your credit score. I know, I am too. So these are some of like the highest interest credit cards that I typically see, just because most of the times they're going to approve most people, but that also means they're kind of taking on more risk. So I just tell people, be careful, especially with those store cards, because I'm sure we've all been into a store where they try to get you to sign up at the register. And they entice you with like coupons, discounts, rewards, which are great if you can use that card and pay it in full every month. But if you are carrying over a balance and paying, 20 to over 30% interest, a 20% coupon is not going to make up for that. So this is just sort of an example of how credit card interest works, especially if people only choose to make minimum payments, which I see pretty often because, again, the credit card, it's kind of unique because there's a lot of flexibility with the payments where you can make a very small payment, that minimum payment, it's just a small percentage. You have the option to pay the balance in full, or you can make a payment somewhere in between there. But let's just say that you have a card with a $1,000 balance, interest is 21%, and then you choose to only make a minimum payment of $30. What are your guesses on how long it's going to take to pay that off, the $1,000 balance? 10 years? That's high. Do you agree? So not that bad, but it is going to be quite a while. So it's going to be over 4 years, and then you're going to end up paying over $500 more than what you initially charge. And again, this is a small amount, like $1,000 is not like a huge dollar amount. I talk to people that have, tens or hundreds of thousands in credit card debt, and they're paying over 20% interest. So when people kind of get into, it's almost like a hamster wheel, right? So you're going nowhere if you're only paying the minimum payment. So I always encourage people, try to make those a higher priority if you can. If you can make even a slightly higher payment than the minimum, sometimes that can really cut down the interest and the amount of time it's going to take you to pay. So just some solutions, like we talked about, try to make higher payments, and the goal ultimately is to try to pay the balance down to zero every month. That's a really common misconception or myth that I hear, that some people have told me that they've been told or they've heard that you should not pay the balance to zero every month because it's going to hurt their score, which is not true. So it's actually best for your score to do that, and also you're not going to be paying interest, and it's not going to take you months or years. And then just a few other options: balance transfers, debt consolidation, and debt management plans. So I'm not going to go into detail of those other options today, but we do offer financial counseling. You don't have to be a member, so if anyone's interested in that, we're always happy to help out and just discuss some of those.
They say there's a credit inquiry, it hurts your score. For example, you fill out an application, let's say for a form or
Yep. Yeah, good question. So the question was like, why, when you apply for things or when there's a hard inquiry, why does that hurt your credit score? So it's a very small percentage in the credit score. It's only 10%. But the reason that they look at it is because if they see somebody trying to open up a lot of like credit or loans in a really short period of time, they might see that as that person might be more likely to default, or that there might be some sort of like financial trouble going on. Because if people, most of the times if people are in a healthy financial spot, they're not going to have to open up, a ton of credit cards or loans in a quick time. So does that help? Okay, yeah. So I know it's frustrating, but yeah, it is something they look at, but it's a tiny. Right. Yep. Yeah, they do. But the good thing I will tell you, only for mortgages and auto loans, they do give you a 2-week time frame. So you can, if you, let's say, have multiple mortgage lenders all pull your credit within a 2-week time frame, it may show as multiple hard inquiries, but it's only going to have the impact once. Yep. Just mortgages and auto loans. But yeah, great question. So this is something I feel like a lot of us, have been told, or we kind of know in theory, but a lot of times we're not told how to have a high credit score, or sometimes we may not realize how much a high credit score can really impact what we pay in the long run for different types of loans. So we saw this earlier, the range of the credit score, and you don't have to have an 850. So as long as you're somewhere in that green section, hopefully more like in the dark green section, so 720 and above, about 720 to 760 for most lenders or financial institutions are going to qualify you to receive the best or the lowest interest rates. So just try to be 720 and above. So this is sort of an example of what happens behind the scenes with lenders when people have different credit scores. So we have Finn and Jake. Let's say they're both trying to get a $20,000 auto loan with financing for 60 months, which is 5 years, which is pretty typical. So Finn, he has a 640, Jake, 730. The dog has a higher credit score. So Finn, his interest rate is going to be 14%, which is really high. Anything like in double digits, 10 and above, typically is considered high for any type of financial product. Monthly payment is going to be $465, and then in the long run, he's going to be paying about $8,000 in interest. So does anyone know what auto loan rates are right now if you have excellent credit? You're pretty close. Yeah. So right now, at least at UMCU, 6.74. So going to be a little bit less than half of what Finn is paying. He's going to be saving, what is that, like $70 per month. And then in the long run, he is going to be saving, I think what is that, like about $4,000 per month because of that difference in the interest and the credit score. So that's why I say try to be as credit healthy as you can, because especially for bigger loans, auto loans, mortgages, it can make a huge difference. So in terms of how you actually build a high credit score, so these are the different factors that go into the FICO score. Does anyone know what the other scoring model is called? There's FICO and there's another one. It's called Vantage. So I always tell people just to check, because sometimes those free credit score places, or like if you get it from your credit card company, sometimes they do give you Vantage, but most banks or credit unions are going to use the FICO score, so that's going to be a little bit more accurate. So the two biggest factors, 35% payment history, which is huge because that's over a third of your score is just making payments on time. And then another really big factor, 30%, is amounts owed or utilization. And I'm going to talk a little bit more about that one, because that one for a lot of people is kind of tricky, or something that they didn't really know about or know how it works. And then the lesser factors, so 15% is length of credit history, or how long your accounts are open, is a factor. 10% is the new creditor inquiries that we were talking about. And then the last 10% is credit mix, or having a variety of different accounts open that you're paying on time helps a little bit as well. Now, something to know with the payment history is that if, let's say, you had a late payment or something negative on the credit report, the older that it becomes, the less it's going to impact you, which is a good thing. So they do kind of look at recency. If it was something that was, in the last year or two, that's going to be, a bigger negative weight on your credit. All right, so for this utilization factor, so basically what this means is if you have any type of revolving account, so that would be like a credit card or a line of credit, you want to try to always keep the balance, or what you spend on it, less than 30% of whatever the individual account limit is at all times, because if you spend more than that, that can have a negative impact on your score, even if you pay it to zero. So just kind of a simple example here. Let's say that you have a credit card with a $1,000 credit limit. When you get your statement, if it showed you had spent $100, that's going to be good, because that is well under 30% of that limit. If you spend $300, it's kind of neutral because you're right at that 30%. But if you spent $800, so meaning you're using 80, 90, 100% of that available credit, again, even if you pay it to zero, because it already got reported at that high amount, that could be a pretty decent drop in your credit score. So again, just try to use, a lesser percentage of your available credit if you can, because that's going to really help the score. Anyone have any questions about this? Because this one sometimes.
I guess, so it would be a little bit confusing if you charge stuff to your card. Let's say you charge $800 before it's reported, so it won't show up as a bill, but you can still submit that you want to pay $800. Credit card to get it back, or $500 to get it back under that.
Yeah, so are you asking like if you made like a mid-month payment before it? Yeah. So, yep, if you, like, let's say you did have to charge a lot on your credit card and it kind of put it over that 30% and you didn't want to get that, you don't want that to be reported, you could make a mid-month payment so that when you get your statement, it shows a lower amount, that 30% or less, and then just pay off the rest, and that would help. Yep. So that can be a great idea, because sometimes that does happen. But, yep, so just trying to keep it a little bit lower. And then these are some great places that I recommend to access your credit reports and scores, which I think is always really important. I know nowadays a lot of places do give us our credit scores for free, like at our financial institutions or credit card companies. So Experian and Credit Karma will give you the score and also kind of a summary of the reports. I like Experian because they do give you the FICO score. Credit Karma is another popular one, but just keep in mind that that is a Vantage score, and there are a lot of ads on it, so just be careful with that. And then annualcreditreport.com, I had mentioned that earlier, but I highly recommend that you check all 3 full reports every year from there, just to make sure that there's not any signs of identity theft, and just to make sure everything is accurate. And then the good thing about these is that they are soft inquiries, so they are not going to hurt your score. That's another common myth that I hear, that people have heard, that if you check your own credit reports or scores, it's going to hurt it. That's not true. So you can check them. You can check your score 5 times a day, and it's not going to bring it down. It's only if you're trying to borrow money, that's when it impacts the score. All right, so we're going to end this with some credit truth or myth. So I just have a few statements, and I think there's 5. So I'm just going to call everyone on in the room, and you'll each answer one of them. So we'll start in the front here. So the more you spend on your credit card, the quicker it is to build good credit. What do we think? Truth or myth? Or we can all answer. We think myth. So yeah, that is a myth. So like we said, the less you spend on credit, the better that is for your score. Second one, you should open up several credit cards in a short period of time to increase your score. Yes, so that is a myth. We just were talking about that. So yeah, and the other thing too is you don't have to have a ton of credit cards open to have a high credit score. When I took my financial counselor certification exam, I think it said people that have the highest credit scores have between, I think it said 4 to 6 credit cards. So again, you don't need a ton of them. And then to help boost the score, you should pay the balance to 0 every month. Yes, that is true. Good job. So yep, pay it to 0, and it takes several years to establish a high credit score. We agree? Okay, a little bit of a mix there. So this one I would say most of the time is going to be a myth. So assuming that, let's say you're starting out at 0, meaning you don't have a ton of collection or missed payments from something in the past. If you have no credit, most of the times in 1 or 2 years, people can be in the good or very good range, or even maybe the excellent category for their credit. So it doesn't usually take a long time. And then the last one says a score can drop by 75 points or more with a 30-day late payment. Yeah, so unfortunately, this one is true. So one late payment, 30-day late or more, can really bring down the credit score quite a bit. So I've seen anywhere from 60, sometimes almost 100 points that your score can drop just from one missed payment. So just tell people to be really careful. Always try to at least get the minimum payments in on time if you can. All right, and so the last thing, just want to talk a little bit about setting good goals. So have any of you heard of a SMART goal? I feel like a lot of us have maybe heard of that acronym before. So it just stands for specific, measurable, achievable, realistic, and timely. So for example, if let's say you want to save money, that's a great goal to have, but just to kind of take it a little bit further, maybe say, I want to save $700 by the end of the year for a new vehicle by putting $100 per month in my UMCU savings account. So just adding those details sometimes will help keep us a little bit more accountable so that we have, those specific items that we're doing and we know how to do it and if it actually fits into our budget. So this is something I would encourage you to look at if you have a goal that you're, for this year, something that you're planning to do. And then I just want to end with this. So what's maybe a financial goal that you have for this year in 2024? If anybody wants to share or is comfortable with that? So how much would you want to save for for a house improvement? So how much to save for a house improvement? I mean, hopefully all of it if it's not something that's necessary. I mean, if it's something essential, that's something that you might have to borrow. But if it's something kind of cosmetic, I mean, if you can kind of just save up and pay for it all, on its own, that would be great. I know that's not realistic for a lot of people. So, I mean, for that, I don't think that there's a certain percentage or amount. Usually if you're trying to buy a home, 3 to 20% is typically what's required for a down payment. But yeah, I mean, if you already have the house and you're just doing updates, then I mean, as little or as much as you want, just make sure that whatever you're expecting it to cost. Maybe look at a calculator online to kind of get an estimate how much it's going to cost you depending on the interest rate or the term, and make sure it fits into your budget comfortably. So yeah, HELOC a lot of times might be an option, or like a home loan, home equity loan. I'm sorry. So, was there any other questions, or anyone that wanted to share a goal at all?
Goal is not to be in debt.
Not to be in debt. Yes, I like that. That's a good one. I think that's a goal for a lot of people. And again, yeah, it's difficult. Like, most of us have some type of debt, so it's not easy. But yeah, especially the high interest debt, maybe trying to get that knocked out. If people have like credit cards, that can definitely be helpful. All right, well, this is my contact information. I think it might have froze here. Oop. So you can see it here, though. So yeah, feel free to reach out anytime. You can reach out to me directly, or that education@umcu.org. That goes to just me and my manager, Mark. So it's just the two of us on the education team that receive those. And again, you don't have to be a member, so we're happy to help out if people have questions, about anything. So credit, debt, budgeting. So was there any other questions? Does a HELOC loan affect your credit? It can. So one way it can impact it is when you apply, that inquiry is going to count against you whether or not you get approved. Again, though, like, if you have a strong credit score, it's not usually going to be a big impact on the score. Could it be? Mm-hmm. Yep. It could help. Yep. So if you, like, let's say you have a HELOC and only have a small amount on it and a large credit limit left over on that, yeah, because it is technically considered a revolving type of account. So it kind of works the same as that utilization factor we were talking about for the credit cards. Yep. Yeah, it's for home equity line of credit. Yeah, so it's basically a loan that you take out against your home, and it's something where there's like a draw period and you can use as much or as little as you want on that, and then you only have to pay back, of course, the amount that you actually used. But it can be a great option for, really a lot of things. You can use it for home improvements or repairs. People use it for education expenses, travel, like, essentially, there's not a lot of restrictions on it, but I always tell people just be careful because it is obviously tied with your home. So if you can't make those payments, your home could be at risk. So. Is it better to buy euros here or in Europe? That's a good question. I'm not sure about that. I guess maybe, I don't know, because the exchange rate, I guess it depends on the exchange rate, but I don't know. It might be good to look online and see if it would have a difference, but.
That probably varies by bank. Probably higher at the airport.
Probably.
Cheaper at a bank.
Yeah.
There's this organization called American Currency Exchange in Germany.
Okay.
The exchange rate is give or take 4 cents on the official rate,
Mm-hmm.
plus $5 anything you don't use. They'll buy it back from you. They pay $5.
Oh, nice.
Yeah, this is American Currency because I came across a similar situation where I was gonna ask a friend in Canada, because in Canada the Canadian banks they exchange foreign currency.
Okay. Yeah, that's a good idea. Or, depending on if you don't need the actual cash, you can maybe get a credit card that doesn't have the foreign transaction fees.
I know Costco's credit card fees that they don't have.
Okay, nice. Yeah, yep. So that might be something to look into too, especially if you do travel a lot, just because those can add up. Yeah. Anything else? Any other questions? Mm-hmm. Yeah, so for kids' college savings, we have a great program called the 529 plan. So that is a great option if you are trying to save up for, and it can be also be used for trade school. So you can use it for college or trade school expenses for children. And actually, we are doing a workshop. I want to say it's next week. It's on our website. So if you go to umcu.org, go under the financial education. But we're doing a virtual workshop on 529 plans, and we have somebody from like who works with those all the time, an expert who's going to be talking about those. But yeah, it's that I would say is probably the best option for exciting. I'm, yeah, Michigan and. Right, yeah, I'm sorry. Yep, Michigan. So yeah, it's a state program, and I'm pretty sure other states have, they might have the same or similar type programs, but right, it's, yeah, statewide. Yeah, mm-hmm.
Question about that is, I have inquired about that. Is it, you open an account, put in a certain amount of money, is there any matching perhaps, or like a CD?
Ooh, that's a good question. I'll be honest, I'm not like super familiar, yeah, with the 529, but if you are, mm-hmm. Mm-hmm.
Is there any kind of a penalty for withdrawal or early withdrawal?
Yeah, I'm not too sure about that, but I'm pretty sure I feel like I remember seeing under their frequently asked questions that they had something about that, like if your child decides not to go to school, like what your options would be. Right. So, yeah. But again, if you're interested, that our workshops are open to anybody, so you don't have to be a member. You can just sign up on our website, and yeah, it's all done online. So, yeah, great questions. But thank you, everybody. So thanks for joining tonight.